Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
Danielle DiMartino Booth joins us. She's the CEO and Chief Strategist at QI Research. Danielle, the market likes what your Fed Chairman Jay Powell had to say yesterday. What's your takeaway?
Well, he didn't say much.
Okay.
I mean, at the beginning, he kind of read a lot of his answers. I'm like, dude, you're still reading. Your statement's over. Quit reading already.
I thought that was weird. I listened to it on Bloomberg Radio, and I thought
it was awkward.
Why isn't this guy taking a stand one way or the other? Why even bother having the press conference if you're not going to say anything?
The dot plot, it's meaningless. We've got all these employment reports and CPI reports before we get to December 12th and 13th. So disregard that. I mean, it was. I'm like, dude, do you know you're talking out loud? You're like on TV.
TV, right?
Yeah. I mean, and I think what was disappointing was that so many of the reporters asked the same regurgitated question. We reworded over and over and over. I'm like, can somebody please take off the gag order and let somebody ask them about the balance sheet already?
All right, tell us about the balance sheet. What would you like to know about the balance sheet?
I mean, gosh, you've seen other deposits, liabilities. My mentor, Dr. Lacey Hunt, I follow them every single week. We're about to break underneath 15 trillion when the data hit tomorrow afternoon.
Wait, what did you say about Lacey Hunt from Hoisington, right?
Yeah, he's my mentor.
Oh,
so
cool.
he's taught me how to. I mean, every single week the Fed's data comes out and it shows you weekly liquidity on bank balance sheets, and you've gone from just about 17 trillion to next week. Tomorrow afternoon you're going to break 15 trillion. You've had $2 trillion of liquidity sucked out of the system because there's like a 1.5 multiple on every dollar of quantitative tightening. Shows up as $1.5 of liquidity being pulled out of the system, which is why your BCY Go function's on fire.
Okay, you've lost me and Paul already. I'm going to say
BCY Go. That's your bankruptcy function. Look,
bankruptcy.
It's companies rely on liquidity. And right now we're seeing banks continue to tighten lending standards. I mean, I'll be up and ready on Monday morning for the senior loan officer survey, but the Dallas Fed has a more frequent lending survey, and it's just getting tighter and tighter and tighter. Everything we heard from Capital One, Ally, they're seeing normalization in defaults, in credit card delinquencies, and auto defaults.
Wait, you said normalization, doing air quotes with your
normalization,
fingers.
air quotes. That means it's going above subprime. Yeah. So it's not contained to subprime. I love to quote Bernanke, but it's not contained to subprime, and that's what we're seeing. We've seen about a 12.5-fold increase of prime auto loans being downgraded into subprime territory based on where they're trading right now on bank balance sheets. We've never seen anything like this. And it's because when you put the rent on hold, the auto payment on hold, when you pay people $2,500 extra a month, when you put the mortgages on, everything went on hold. So we saw, and Moody's has done some good work on this, we saw insane levels of FICO score inflation during the pandemic. And now it's all coming back to bite because wages just aren't there, and layoffs are. I mean, you've got continuing jobless claims up 6 weeks in a row, north of 1.8. Right. They're just on top of where they were in 2016.
So is your biggest concern that the consumer is not nearly as strong as maybe we think it is?
Oh, I think the consumer's telling you they're not as strong. I mean, if you looked inside of the final University of Michigan consumer sentiment print at the medium tercile and top tercile of earners, they're like, job cuts are coming. And it's the lowest tercile that doesn't see it coming, but we're seeing it come out in the data week after week after week. I was talking to dailyjobcuts.com, the founder, and he's like, November is seasonally a quiet time. People don't fire people into Thanksgiving and the holidays. And he's like, it's out. They've come out of the gate. He's seen 25 companies close in 2 days.
This is the Austrian hangover coming after all of that insane stimulus. It's still going on. Remember that Keynes versus Hayek rap video?
From the
great financial crisis?
You've got some people are going to be paying their mortgage for the first time in December. That's how long FHA forbearance has been going since March of 2020.
All right, I got a listener question here writing in. Did Danielle listen to the Druckenmiller interview with Paul Tudor Jones? Stan thinks rates are going higher because of an out-of-control debt profile of the U.S. Do you agree?
I don't.
No.
I know. I mean, we've been spending like drunken sailors since Reagan was in office. It's just, I think Wall Street wants a narrative right now.
But Reagan boosted spending on the military.
He did.
We were talking yesterday to Paul's mentor, Cam Harvey from Duke, and he pointed out that next year we're going to have interest payment costs of $900 billion. Yep. We're going to pay more to service our debt than we do to fund the military.
Yep. Actually, we passed that up at the end of the fiscal year. It's about $685 billion for military, $808 billion fiscal year ended August 31 interest payment. So we've already rounded that. And the shame about the fiscal spending right now is it's not doing much. It's not creating anything. Like there's no Hoover Dam, there's no Holland Tunnel. There's so that little that's being created.
They're working like crazy out there. The people out in Jersey, right, John Tucker? They were building like
new tunnel.
Remember
those gigantic cranes by the Gateway Project?
So my question,
I stand corrected. Yay, we're building a tunnel.
Yeah,
it'll be ready in 20 years.
Only thing we care about in
I'm always on the bridges going to LaGuardia. Sorry.
Yeah, exactly. So is recession in your scenario? In your outlook?
I think recession starts the current quarter.
Okay.
This quarter, Q4
we have,
2023.
And as of this morning's jobless claims data, the only state holdout right now that does not have continuing jobless claims year over year is Kentucky. Well, I mean Florida, but that's a base effect from Hurricane Ian, so that's going to go away here. But that's it. I mean, September 2022, there were 0 states with rising continuing jobless claims. Now we got 50.
Okay, so you have a recession in your outlook. How deep, how long?
I think it's going to last longer than we think because we've pulled so much demand forward. We're seeing one furniture company after another go out of business that have been in business for 100 years because we pulled so much demand forward with all that stimulus money.
All right.
That's the hangover, dude.
It is a hangover.
Yes.
But it's not as funny as the movie.
So, so should the Fed, what should the Fed do here?
I think the Fed's on hold. I really do. But again, it's about the balance sheet. Nobody's talking about Voldemort. I'm saying it out loud. It's about the balance sheet, people. It's real.
The worry is that the Fed went too far, right? Yep. Because like Cam said, if you take out whatever they call it, rent equivalent, inflation is below 2%. And our buddy Jay Hatfield from Infrastructure Capital,
another smart one,
he's got his CPI-R, where they replace the housing component with Case-Shiller, and that's 1.3% year over year compared to the 4.3% that we're.
But everything's great in Dallas, right?
Well, no.
Oh,
actually, warn notices in the state of Texas have gone through the roof.
Really?
That's what's hard to believe, and it's no longer like super cheap to live there. So I mean, Austin's a cesspool of when it comes, it's residential real estate, ground zero. It's a mess.
I love a good.
And I'm
cesspool.
a Longhorn, and I mean, I love Austin, but they overbuilt.
They overbuilt, and they don't have any infrastructure for the traffic.
But they have Lime scooters. That's all I care about. Bird
Danielle
scooters,
DiMartino Booth, CEO and Chief Strategist, QI Research.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
A little bit of a M&A trade in the theme park business. Cedar Fair, Six Flags, they're getting together, all-stock merger. Let's break it down a little bit. We can do that with Jody Lurie. She covers the entertainment companies for Bloomberg Intelligence from the credit side. So, Jody, thanks so much for joining us here. Boy, I'm looking at the balance sheets of these two companies. They're almost the exact same. $2.5 billion of debt, about $500 million of EBITDA. So they're both levered pretty highly at around 5 times leverage here. From your perspective, what's the rationale for putting these two companies together?
Sure. So, Paul, I mean, I think it's a great question. Is that really at the end of the day, why are these companies joining? And I think it really comes down to the fact that the tailwinds that they experienced during the pandemic have sort of petered off. And now they're saying, what's next for these companies? They've experienced tremendous weather-related issues this year that have sort of marred their opportunity in benefiting from people spending on leisure.
Wait, what were the weather? Is it too hot?
Yeah. Well, so some places it was too hot. Others it was too rainy. It was just a mix of storms and events that have happened. I mean, you look in the Southern California area, and it was too hot, and then there were floods, and then it was rainy, and it's just, I mean, each of their calls, other than this one today, which obviously was just focused on the M&A transaction, but the past 2 quarters, that was sort of the explanation behind it, was we didn't do well or as well as expected, and we didn't get as much season pass buyers because of the effects of weather. And I don't know if that's necessarily going to go away, but I think what they're hoping is the expansion of their footprint will sort of diversify them enough to make it so that weather isn't as much of an issue. I don't know if that's necessarily what I'd hang my hat on, but that's certainly their argument.
Look at Disney. You look at Disney, they love their theme park business. Comcast loves its Universal theme park business. Both of those companies are increasing dramatically their capital spending in those businesses. Is that just a benefit of scale, and that Six Flags and Cedar don't enjoy that same kind of scale? So this is one way to get there?
Well, I would say that they definitely have a lot of scale, particularly Six Flags, maybe even some would argue too much scale. It's a different business model when you're dealing with regional versus very focused theme parks, right? So Disney, like SeaWorld, benefits from having Florida, having Southern California. And so that, of course, helps them from a cash flow perspective, more consistency, because they don't have to shut down for part of the year. For Six Flags and Cedar Fair, it's a little bit more regional. The type of customer is a little bit different. It's not as much destination. They're hoping to shift that a little bit, and you're certainly seeing that. Cedar Fair does have hotels at some of their properties. And so I think that the thought process is that once you're a bit larger, you can more actively have a branding and maybe more of a presence everywhere you go. So if you're a card carrier of a Six Flags Great Adventure, you can go to any Six Flags, perhaps, maybe that's the play, is that, a customer can participate in any area.
Wait, can I ask about the dreaded phrase merger of equals? I think they're saying this themselves. Like, they think it's a good idea to spin that. Daimler Chrysler said the same thing, and it was anything but. I mean, what a load of BS. Who's buying whom here?
Right. So they structured the deal interestingly. So Cedar Fair is an LP, or an MLP specifically, so a limited partnership right now. So they have unit holders. Six Flags is your standard C corporation. And the way that they structured it is that Cedar Fair will get 51.2% of the new company shares outstanding. And the reason why they did that is I think it sort of helps them to not trigger the change of control provision for bondholders, meaning bondholders can't then put back the bonds at 101% of par. And so that, of course, frees up some cash for the two companies. It makes it a really stock for stock transaction, except for the dividend that Six Flags shareholders get with the closure of the deal. And so I think it's an interesting structure. It makes it a little bit more beneficial for bondholders in some sense, particularly the Six Flags bondholders. We saw the bonds rally today, and that's a function of the fact that, Cedar Fair does, to some extent, they've had better results, at least recently, and their business model has been a little bit more
right. Well,
it's been stronger.
So yeah. They have Cedar Point, which I grew up going to that in Sandusky. They have the Beast at Kings Island in Cincinnati. When I was a kid, that was the longest, the fastest, the tallest wooden roller coaster in the world. Jody, you've got, I'm guessing, real amusement park experience. What are the best rides out there? What are the rides that that roller coaster freaks are psyched about?
Well, there are quite a few. It's funny because I have this conversation a lot with, I'm going to name drop Ira Jersey, who sits in my little hubble in Princeton. His son is a roller coaster enthusiast. So we're constantly trading discussions about all the different roller coasters out there.
So which ones are the best?
I mean, I'm a traditionalist. I grew up relative, once it finally came out, the original Batman ride, not, that was in Great Adventure. I just always have a soft spot for that, as well as for Steel Force, which is at Dorney Park. And so, I mean, those are just rides that I always went to just because it was a regional sort of feel. That said, I mean, Disney obviously has its own sort of
Space Mountain.
Right. Well, they have Guardians of the Galaxy now, which was certainly an intense ride. Definitely different. I mean, from an innovation standpoint, they certainly do a different sort of innovation than what you see at the 3 regional guys.
All right, Jody, thanks so much for joining us. Appreciate it. Jody Lurie, credit analyst at Bloomberg Intelligence, breaking down this Cedar Fair and Six Flags deal. It's a merger of equals, is what they're calling it, but trying to get a little bit of scale in that theme park business.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Darkening the door here is Doug Adams. He's global co-head of ECM, that would be Equity Capital Markets at Citi Bank, one of my former places of employ. I used to run the street with Tyler Dixon. We would do deals. One day he called me up and he says, "Hey, I just took down a bunch of this Clear Channel stock. Can you tell me what how a radio company works?" I was like, "What?" I mean, that's the kind of risk we would take back in the day. Maybe stupid risk, but anyway, Doug Adams does I'm sure a better job than Tyler. Doug, thanks so much for joining us here. Appreciate it. Talk to us about the equity capital markets these days. It's a tough market, tough geopolitical issues. I'm sure the companies don't have a lot of confidence maybe in their forecasts or kind of just even the next couple of quarters. What are the kind of conversations you're having with clients these days about their capital structure?
I appreciate the opportunity to share our thoughts with you. And you're right, it's a complicated market right now. We're dealing with a number of issues globally. And there's a lot of uncertainty. And so clients are trying to manage their balance sheets, trying to manage their forecasts through that time. I do think we are expecting there to be some capital raising come in. There are companies that need to raise capital over the coming weeks and months. But as far as the IPO market, I think what we've seen in the performance, and you were just talking about it, some of the aftermarket performance hasn't been as strong as folks had expected or anticipated. And so in reality, we're probably waiting until 2024 until we start to see a bigger pipeline of newly issued public IPOs.
So does that mean 2024 is going to be a better year than 2023 for IPOs?
That's certainly what we're hoping at this point. I mean, it's been a...
What if we fall into a recession? Does it still look like it could be a good year for IPOs?
There are a lot of companies lining up, and a lot of them have secular growth as opposed to being exposed to cyclical aspects in their business. The one thing that we have seen, and we're tracking, over 1,000 companies private companies right now, and there's a lot of really interesting, really exciting companies. The real question is, when is the right time for them to go public? When are they going to get the reception, both at the IPO, but importantly, are they going to see the aftermarket performance? And that's been the biggest struggle of the recent vintage.
Some of the deals that came public, Doug, after Labor Day had what they call marquee investors. Or I'm not sure what the term is. I never had them in my deals. Whatever that top allocation was, I gave Fidelity twice that amount, and I'm done. What are these marquee investors, and how's that come into it? And is that important?
Yeah, we refer to them today as kind of cornerstone or anchor investors.
Yep, that's the term.
And part of it is in a market that's reopening, like we're going through. Part of it is, how do I de-risk a transaction?
Okay.
And so those investors act in two things. One is they take some of the potential supply. And the second thing that they do is provide a validation for investors and give them confidence of a broader group of investors that people have done more work, they've met the company privately early on, and they're willing to go on the cover of a prospectus. And so that provides greater validation in the market.
So what's the, where are we in terms of the private equity business and the private credit business? Because it seems like companies can stay private a lot longer. There's so many sources of capital for them. They don't need maybe to go public as much as maybe they did prior. Where are we in that continuum these days?
Yeah. And so at Citi, we run our public and private capital raising all through our group in equity capital markets. And we are seeing that convergence, right? And so investors or companies are thinking about, where do I raise capital? what are the alternatives in the private market? What are the alternatives in the public market? And how do I think about that? And you're right, there are more alternatives today in the private market, but that's not a perfect market today either, as we've seen. I think that the real question for companies is there strategic value in being public? And what's the value? It helps in retention of employees. It helps that it's an acquisition currency. And for many companies, it helps from a branding event for them. And so there are different reasons to go public than just raising the capital at the time of the IPO.
I mean, how much have you, when you're looking at your employees, right, in your group, have you seen a shift from the amount of women and men you hire to take companies public and the amount of women and men you hire to give them money on the private side? I mean, you've been at Citi since like Nirvana, right? So
yeah,
the band.
Okay,
you've been at Citi since the early '90s, right?
I have. In terms of where people are spending their time, we've asked our team to really focus on understanding what companies' needs are, and then thinking about both public market solutions as well as private market solution. And so the teams are versatile to be able to talk to clients about the different alternatives that exist. And that's one of the things that we've been really focused on is understanding the client and coming up with solutions that best fit their needs.
On the private, I know a source of IPOs across the street of private equity finance companies, and you always are talking to your private equity clients about kind of what their needs are. There haven't been a lot of IPO activity for several years now. I would think the backlog from the big private equity companies are like, guys, you give me a 5-minute window. I got to get some stuff out the door because I need some monetizations. I need to mark these things. I need some gains to show my LPs. Where is the backlog, out there on the street these days?
I think there's no question private equity firms are evaluating their portfolio companies and trying to decide which are the right ones to exit in the public market and which are the right companies to exit in the private market. And they do that all the time.
Yep.
I think with a better functioning leveraged finance market, one of the things that has happened is the notion of a dual track process has become back in viable alternatives for companies versus just having one alternative. Having multiple alternatives always help those sponsors. But you're right, they are under a lot of pressure to return capital to their LPs as they look to raise the next fund.
Exactly. So what's it used to be back in the day, my day, we could take a company public with just a thought, an idea. Now you have to have revenue. You have to have profits. You have to have defendable franchises. It seems tougher and tougher. Where's the market now in terms of if I wanted to bring my company public, what would you tell me I'd have to have?
We focus on companies that are either profitable or a clear path to profitability in the near term. And that's what investors want. When we're in a market that's reopening, you have to really open the market with the highest quality companies. Rebuild the confidence that's been challenged over the last 24 months. One of the things going back to 2021, prior to 2021 or 2020, there was an argument that companies were staying private too long.
Yep.
And in 2021, everyone said companies are going public too early. And so finding that right balance, especially in a market that's recovering, it's not a straight line. And so starting with the strongest companies, rebuilding that confidence in the public markets, and then giving options to companies in terms of when and how and how large to raise capital becomes important.
Are there any sectors out there that you're seeing more or less demand from your clients? Hey, we want more energy, or we want more tech, or what are you hearing from your clients?
The clients are focused on growth.
Yeah.
And quality of company. So I don't think it's necessarily
those two things didn't used to be the same thing, right? Growth and quality. And when you say quality, you mean like free cash flow, right?
Or profitability or path to profitability. People that have built a moat around their businesses and are differentiated. There's a lot of companies working on really interesting, as I mentioned earlier, strategies and disrupting traditional industries. But the real question is, have they proven that they can actually operate as a business as opposed to a plan in those areas? But we're seeing companies certainly in the software space, in technology more broadly. We're seeing companies in the consumer space. Healthcare has been one of the most active spaces in the capital markets. But we're also seeing companies in financial services, real estate, and others trying to figure out when will be the right time to access the public market.
Are hedge funds, where are the hedge funds in terms of buyers of IPOs or just new issues? How important are they to an underwriter like Citi?
Yeah. Look, all the investors, the active equity investors are important. So long-only accounts, the mutual funds, hedge funds, all make up kind of the complexion of the investor base. And one of the things is we look at the IPOs that came post-Labor Day, it wasn't a demand issue. Yeah. Right? Those transactions were multiple times oversubscribed. The challenge has been the aftermarket performance. And part of that is, and regardless of whether you're a hedge fund or a long-only investor, the average or the typical active equity investor are trailing their indexes because the indexes have been dominated by a small number of stocks. And so if the stock isn't performing well, they can't chase that in the aftermarket. They have to cut their losses rather than suffer.
Because I kept wondering, because I said, back in my day, I'd know where you're buying here, how much you're buying. So if the stock does fall, I know you're coming in to buy more. But it seems like we didn't see that this way.
Yeah. I think there's some technical factors and some fundamental factors. I think the technical factors is the underperformance by the active equity investor relative to their benchmark. And the fundamental challenge has been, the 10-year has moved pretty significantly since Labor Day. So the cost of capital for these companies has gone up significantly.
All right, Doug, great stuff. Appreciate you taking a few minutes of your time to come across the street and talk to us. Doug Adams, he's global co-head of ECM for Citi.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
There's a thing, Matt, in the healthcare business called Obesity Week. It used to be a quiet annual meeting of weight loss specialists and a few pharma reps. But over 4 days in Dallas this month, it became clear that the new obesity drugs are changing that, along with everything else in their path. Lisa Jarvis joins us to break it down. Lisa is a columnist with Bloomberg Opinion covering biotech, healthcare, and the pharmaceutical biz. Lisa, can you put into perspective what these GLP-1 drugs are? How impactful are they? Where are we going with this stuff? Because it came out of nowhere, and that's all anybody can talk about these days.
Right. Thanks for having me. Well, yeah, they're taking the world by storm. That's for sure. They've been used, this class of drugs has been used for a long time for diabetes. And a side effect was weight loss. And so they decided to amp that up and, explore the drugs for use just for weight loss. And the difference between what they can do and kind of all the older diet pills that existed is vast. In the past, basically what you could expect was at the most about 5% weight loss with some of these older diet pills. And it was often not sustainable. With Wegovy, which is Novo Nordisk's drug, and with Mounjaro, which is Lilly's drug, still not yet approved for weight loss, but expected to be by the end of this year. You're looking at somewhere between 15, even up to 25%. Some of the newer drugs that are in the pipeline, for segments of the population, up to 30% of their body weight. So it's pretty dramatic, and needless to say, and it's really taken the world by storm.
I just want to lose like 10 to 15% of my body weight. But apparently, Novo Nordisk has put the starter doses on hold because they just can't make enough. And we asked the CEO today, Lars Fruergaard-Jørgensen, what are you going to do about the supply? He's so cagey about it. He's like, we have a plan, but I can't tell you about it. Which is why, if you're boosting capacity at factories, or if you're making it in a different country, or why would you not be able to tell us about it? I don't get that.
Yeah, it's been an ongoing struggle with all of these drugs. The fact that they can't keep up with demand. I think the issue is less the actual ingredient in the drug itself and more the vials that they put it into. And so they've been really, you're right, cagey about it and been really careful about allowing new people onto the drugs. The problem is, there's this whole gray market of compounded pharmacies that are offering the drug. So people are starting on it, buying it from kind of telehealth places, somewhat sketchy, I would say. And
I heard a commercial yesterday on Bloomberg Radio on Sirius XM channel 119, and it was for what sounded like probably a pretty sketchy place, saying hey, call us up, we can charge this to your insurance, trust us. And I was thinking, cool, because it's $1,000 a month, right? Can they charge it, Lisa, to my insurance, or do I have to pay myself?
Well, that's the thing with these drugs right now. Very few people are able to get them covered by insurance, because insurers are worried about how much it's going to cost in the long term if everybody goes on them. And the idea is that you take them for life. That could be a significant burden to most plans, given the number of people in the U.S. who are of a body weight where they would qualify for these drugs. When it comes to the telehealth, they're often charging less, probably because they're getting it from a different source, and you're maybe taking it not in the pen form, and maybe you're having to inject the drug itself. It wouldn't be something I would recommend. I've written another column about that that I think most doctors would say, don't do that. Just hold off and try to get it from, the real deal.
This is, Lars was telling us this morning too, because I said, dude, I don't care that much about stomach problems. I definitely don't want suicidal thoughts, which some reports have said, that's a possibility, potential. And then I'm terrified of needles. And he said, a lot of people like to go to the doctor once a week and get a shot. Is that possibly true? Like, I can't even get off my couch to go to the gym. I'm definitely not going to find time to go to the doctor.
I think so. Well, you don't have to go to the doctor. You do it at home yourself, just like you do with if you had diabetes. Because the people who are taking Ozempic instead of Wegovy, Ozempic is the same drug, lower dose approved for diabetes. But there's good news for you in the sense that there are pills that are in the works that could replace the need for needles. The weight loss might not be quite as dramatic. We don't know yet, but it could still be substantial. And some of those pills you might not even need to take as often as the injection. So there's a lot of different things that are in development, because obviously at a market that people are pegging at like $100 billion by 2030, everybody wants to get on it. So, yeah.
Is there any scenario, like I was going to ask you the size of the business, but that's a big size. Is this always going to be, or is this expected to always be a prescription type situation, or will there be an over-the-counter option at some point?
I think we're going to stick to a prescription for the foreseeable future, in the sense that people are going to want insurance to pay for it, and oftentimes with over the counter, that's not something that insurance always covers. But especially as we start to see this drug, more data come out for the health outcomes. So we're talking about weight loss, but Novo has offered some data showing that taking this drug can reduce the risk of heart attacks and strokes by 20%. That's substantial. There's a lot of other trials running trying to show other health benefits, whether that's, chronic kidney disease, NASH, which is fatty liver disease, or even addiction. So I think probably we're not going to see it over the counter. And the market is just so potentially huge as a prescription drug.
And it's kind of odd to think about this to be a drug you have to commit to for life. I mean, it's one thing if you're doing that for a disease or something that you have to, but this is more.
On the other hand, dude, I'm committed to like Haagen-Dazs and Heineken's for life, right? And I might even spend less on Wegovy or Ozempic if I can, I don't know, like I don't know how much it's going to limit my cravings to drink alcohol, to eat sugary foods, to smoke cigarettes, but apparently it helps, Lisa, with all those things.
So far, anecdotally at least, it seems to be helping with all those, and it's now being studied as for addiction. So whether that's alcohol, other drugs, illicit drugs, or other things, but and we could think of sugar in that same way. I've talked to a lot of people who are taking these drugs, and they just, most of them say almost instantly, like within the first 24 hours, they feel a change in their kind of brain signals telling them to eat. And so I think some of the concern is more about making sure people are getting enough nutrition, to be honest with you, because for some people, their diet is so depressed that they just they're not craving Krispy Kreme anymore.
That's the interesting thing is, a couple things. Can this reduce fat only and not reduce muscle mass? And then also, if people are smoking more weed, are they going to need this to counteract the munchies?
Well, fair enough. Although they might not desire the weed, to be honest with you, if they're taking the drug. So that's one thing. It's just hard. Everyone has a different experience with it. Some people just lose their desire for, whatever was their vice.
You look just crestfallen, Matt, on that news.
Yeah, I mean, I think there's a lot to we still just don't know, about how long people are even going to want to, for example, not enjoy some of those things in life. I spoke with some doctors who said they have patients who just want to take a break because they want to go out to dinner and for their birthday and drink alcohol.
Have their cake and eat it too.
Yeah. Or at least pause. But so there's sort of like a lot of discussion about how is this sustainable in the long term? Could you take down the dose? Could you take breaks? How could we think about what it looks like in the long term so that you can maintain that weight loss? And like you said, thinking about the muscle mass too. And I'll just note the companies are also looking at ways of combining these drugs with drugs that help you sustain your muscle mass. So could be a whole new.
I'm gonna let other people take the lead on this. I'm gonna be a big time follower. Lisa Jarvis, thanks so much for joining us.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's kind of continue that legal thing. Our next guest, Nouvelle Gonzalo, founder, Gonzalo Law Group. She joins us live here in our Bloomberg Interactive Broker studio.
Where'd she get her JD?
The
Ohio State University.
That's right, the Ohio State University in conjunction with Oxford University in England.
Oh,
so
nice.
the two,
Awesome.
But yes,
I feel like
Ohio
those
State.
two are on the same level as well. OSU
They're
and Oxford.
excellent. They're both excellent universities.
Exactly. All right,
one has a better football team.
One has a better football team, depending upon how you define football.
That's right.
All right. Let's talk about Meta first, because
Yes.
they have been sued by California and 47 other states. Talk about harmful youth marketing. What's going on? I mean, the stock, nobody cares in the stock. Stock's up 155%. From a legal perspective, is there anything there?
Oh my gracious, this is huge. This is an amazing case because you were looking at over 43 attorney generals from different states that are bringing this case against Meta. And we're talking about a platform that owns Facebook, Instagram, Messenger, WhatsApp. There's about 4 billion users worldwide. What's that?
Threads.
Okay.
That's their new Twitter competitor, right? Threads.
Yes. So, this is huge. And we have not seen this type of bipartisan support with 43, states going against them. But essentially what the issue is here, this is not only data privacy law, but this is data privacy law in children. Because essentially what the states are arguing is that, hey, you are intentionally harming children with how you're handling your platforms, the features that you're putting in place. And there were internal memos that were leaked from Meta into the public marketplace, and we found out that Meta was aware of the harm that some of its features cause to children. And so now the states are in an uprising over this. So that's what we're doing. That's what we're watching with this case and watching the impact with it. And essentially some of the main concerns, because you might say, okay, well, look, listen, isn't this just business as usual? Companies want to have platforms that their users want to be on. They want to make it user friendly. They want people to be engaging with it. So how is this that different? But the concern here is not just that, okay, we have an engaging platform, people are using it. But the concern here is that they have a platform that is specifically geared toward and working to psychologically hook kids. And so you say, okay, well, what features are that? I mean, isn't it just kids, online socializing with one another? But actually, we see the comparison-like feature. The filters, they say, are promoting body dysmorphia and eating disorders. They're, saying, oh, did you have that?
No, I have none of that. What I'm fascinated by. Look, there's a ton of studies that show us that social media is in general toxic, but it's especially toxic to children, but so are lots and lots of other things. Hey, if our product is bad for you,
right?
Well, but isn't this something parents are supposed to regulate with their kids' screen time?
I was thinking exactly the same thing.
To me, the bigger concern with Meta, I still call it Facebook, is they and Google just dominate online advertising. It seems like there's a little bit of an antitrust question. How are two companies driving, the vast majority of ads online? It seems there should be some competition in that space.
It does seem, I was going to ask you, Nouvelle, is this kind of a way in for prosecutors who have concerns about monopolistic behaviors, but just can't seem to bust him on that. Kind of like, when they were going after Al Capone, they wanted to get him for organized crime, and they actually ended up getting him on tax evasion.
Always taxes, right?
So I just wonder if they're trying to, is this a way for them to go in a back door and maybe kind of break up or minimize a little bit the power of someone like Meta?
I'd say that it's possible, but it's not likely. And that's because they're not asking them to break up their companies. They're asking them to regulate how they're obtaining information on the users and to really comply with data privacy laws. And so that's a different question that we're asking. And so when we're saying, okay, you're doing psychological research on how to make sure things are engaging for children, how to make sure that you're hooking them, you have research that shows it's harming them, but then you say, hey, we're not doing anything wrong. What's the problem here? This is very similar to what we saw with tobacco companies, what we saw with big pharma. And so we have to look at this really closely. It's not just a matter of, okay, right, parents need to regulate what the students are doing, what the kids are doing. But if you have the information, you know what to regulate.
So you lived in Europe for a long time.
Yes.
Europeans seem to take the right to privacy laws much more seriously than we do in the United States.
Yes.
Wouldn't those sort of things that say it's my data and I can control it, and Facebook, or for that matter, Apple, Google, Amazon, can't be selling and reselling, isn't that the choke point to generate some control over not only how these companies affect us, but specifically what we allow them to do with our minor children's data?
Barry, that is an excellent question, and I couldn't agree more. What we're seeing in the United States is we take a lot of our privacy laws from the European model with the General Data Protection Regulation, or the GDPR. And so we're taking our laws a lot from that, or kind of adopting our own set.
But not as strict. We seem to be much looser than the Europeans.
We're by state. So we'll see, each state has their own sets of regulations, California, Illinois, and so forth. But we are looking at how they do things. And the reality is, yes, we have those regulations. Yes, we have it to protect, but if they're not being followed, then that's the problem. And that's what's being alleged here, that they're violating some of the children's data protection laws. Okay. And so and I will tell you, if they violated either the children's data protection privacy laws or even any of our state ones, they absolutely most likely violated the global ones, because anytime you have a user from the EU, any part of Europe, the GDPR comes into effect. So I will tell you, it's most likely also that the EU regulators are watching this case very closely, because if they are in fact found to be in violation of privacy laws, consumer protection laws, then we're also going to see probably some issues abroad as well.
What are the damages? If Meta loses the case, what sort of options are going to take place? Is this going to be them writing a big check, or are they going to have to change how they do business?
I think we'll see a variety of things. One of the things that ended up coming up is they were getting ready to launch Instagram Kids. And so Instagram Kids was a platform.
That's awful.
A platform for children aged 13 and under. Wow. And so you're talking about some of the most vulnerable parts of our population. Children's minds are not even developed yet. And so they did this, and they were in works with it. Another memo was leaked, and when that was found out, over 40 U.S. states went ahead and wrote Mark Zuckerberg and said, listen, please stop it. Don't do it. Don't move forward with it. And they did. They paused it. So we might see injunctions here, so a pause on work that they're doing or projects that are in the works. We might see a change in the platform and modification. We'll probably see some more disclosures, because you can't protect what you don't know is out there or happening to your child. So if you think, oh, what's the harm in letting them, have their comparison-like future or put their filters on? But if you don't know that there's research that this harms your child and there's an intent or a problem, you can't regulate it. So you'll see disclosures.
All right, Nouvelle, thank you so much for joining us. Nouvelle Gonzalo, founder of Gonzalo Law Group, bringing us up to date on some of the legal challenges out there for Meta as anybody, in this case the state, trying to get a handle on some of the content that's being consumed out there, particularly by kids. So we'll stay on top of that.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.